But wait, before we talk about risk, let's get down to the basics. What is stock? Stock is ownership in a company. Let's say I start a company that makes and sells stereos. We'll call it Super Stereo. When you buy shares of Super Stereo, then you own a part of that company. You become a shareholder. Wow, what a title! And with that title comes some perks, like dividends, voting rights, and if you picked a good company, a strong return on your investment. Now, you may be wondering why a privately owned company would offer you, the public, shares or a partial ownership in the company. Companies sell stock to raise money for expansion and growth. When private companies offer shares or go public, they are asking people to invest in the idea that their business will be successful. The first time a company issues stock is called an IPO, or initial public offering. The proceeds of this sale go to the company, and in return, the stockholders own a part of the business. Highly anticipated IPOs have raised as much as $10 billion in one day. In order to be eligible to offer stocks, companies must register with the SEC. Accountants and attorneys submit the required financial statements in a prospectus. The prospectus is a report that outlines the company's financial condition and explains how the company plans to use the proceeds from the sale of stock. The SEC provides this information to all interested investors. People looking for a wise investment study the prospectus to determine whether or not they want to invest in the company. It's simple supply and demand. Companies supply a fixed number of shares to the public. If a high number of investors anticipate a bright future for this company, then they will compete to buy the stock, driving the price of the stock up. Once the shares are initially purchased, they are open for trading on the stock exchange. Investors buy and sell these shares for a profit or loss. The company itself does not receive any future proceeds from the exchange of these shares. However, the company's performance does affect the share's market price. If confidence in the company weakens, stockholders will try to unload or sell the stock to capture a return on their investment before the price falls. If other investors sense a lack of confidence in this stock, they may avoid it, driving the demand for the stock down as well as the price.